Hello and welcome. Today we're going to talk about a strange but important term in investing, the dead cat bounce. Yes, it sounds odd, but it describes a very real pattern in the stock market that every investor should understand. A dead cat bounce happens when a stock or even the whole market drops sharply, then briefly rises and then falls again. It's called a dead cat bounce because even a dead cat, if dropped from high enough, might bounce. The term is used to describe a short-term recovery that fools people into thinking the worst is over, when in fact, the price is likely to fall again. It's a false recovery, a temporary rise during a longer-term downtrend. Let's look at an example. In March 2020, when the COVID-19 pandemic began, the stock market dropped very quickly. The S&P 500, which tracks the 500 largest US companies, fell by over 30% in a few weeks. Then suddenly the market went up by about 10% over a few days. Some investors thought the crash is over and started buying again. But that recovery was short-lived. The market dropped again soon after, reaching new lows just days later. That short bounce before another drop, that's a classic dead cat bounce. Dead cat bounces happen because investors get hopeful or try to buy the dip, thinking prices will recover quickly. Some traders are also trying to make quick profits. But if the fundamentals haven't changed, for example, the economy is still weak or bad news is still coming, then the bounce won't last. Understanding this helps you avoid getting caught in a fake recovery. So to sum it up, a dead cat bounce is a temporary rise in prices during a longer downward trend. It can mislead investors into thinking the market has turned around when it hasn't. Before jumping in after a quick bounce, ask yourself, has anything actually improved, or is it just a short break before more selling? Invest smart, stay patient, and remember, not every bounce means a recovery. Thanks for watching and see you in the next video.